Today we're covering another question that comes up all the time. What happens when you turn a rental property back into a primary residence? So we also have a video that is the opposite. It's what happens when you have your primary residence that you convert into a rental property. So that's a whole topic. This is actually in the reverse situation because we have a lot of investors who will have a rental property that they were using for long-term or short-term rent, and then they actually convert that and they carry it back over, they move in and they start to use that as their primary residence. So what happens in that situation if you are using cost segregation and depreciation? So this is the reverse of converting a home into a rental, and it has a very different set of rules with the IRS, especially when it comes to depreciation and cost segregation, bonus depreciation, and then the home sale gain exclusion under Section 121. That is the primary home sort of capital gain exclusion that you get for your primary residence. By the end of the video, you will understand when depreciation stops, how your new basis is calculated, what happens with cost segregation, how depreciation recapture works, how the home sale exclusion is affected, and what you can expect when you eventually sell. So let's jump in. So number one, depreciation stops the day you move in. So under Section 167 and 168 of the IRS tax code, you can only depreciate property that is used in a trade or business and is held for the production of income. And so once you move into that property, the depreciation for that immediately stops. If you converted the property on July 1st, let's say, you can only take depreciation from January through June for that particular year. And then once it becomes your primary residence, it is no longer a depreciable asset. But here's the really important part. Stopping depreciation does not erase the depreciation that you already took. And so that brings us to the next rule, which is that your basis is permanently reduced by the prior depreciation. Your future basis, meaning the number used to calculate the gain, or essentially your cost for the asset, that is used to calculate the gain when you eventually sell that. It is referenced by all depreciation that is allowed or allowable under the IRS Code Section 1016. I have to throw those in for some of our technical and CPA partners. What this means is even if you forgot to take depreciation or your CPA didn't take the full depreciation, the IRS still reduces your basis as if you did. So let me give you an example. If the original building basis is $400,000 and then your total depreciation amount that you took was $110,000, then your adjusted basis going forward, it's 400,000 minus 110,000, which equals 290,000. That's the difference. That 110,000 does not disappear. It is waiting for you later when you sell. And so then what happens if you do cost segregation? Well, if you completed a cost segregation study while the property was a rental property, you probably took accelerated depreciation. So you did that through 5-year property, 7-year property, 15-year property. There are different categories and timelines, and then possibly applying bonus depreciation. So when you convert the property to personal use, nothing gets reversed. All of that accelerated or bonus depreciation still remains valid. That's a huge opportunity. However, when you eventually sell the property, those components trigger a 1245 depreciation recapture, which is taxed at your ordinary income rates, even if you lived in the home for 10 years. After converting it, the IRS still treats that earlier depreciation as a taxable gain. The personal use years do not eliminate or reduce the recapture just because you lived in it. And so how does the 121 exclusion work? Well, that's a big one. So the 121 exclusion it's the safe harbor when you own a home where you get an exclusion of $250,000 or $500,000 if you're married filing joint. That is sort of the exclusion when you sell your home. That's Section 121. You can exclude the 250 for a single filer, 500,000 for married filing jointly, but there are 3 limitations if the property was a rental property first. So number 1 limitation, depreciation recapture can never be excluded. So Section 121 is very clear. Any gain that is attributed to depreciation after May of 1997 cannot be excluded. So if you took $110,000 of depreciation, including the cost segregation, the $110,000 must be recognized as taxable income when you sell the property. There are no exceptions. Now, point number two, non-qualified use. This is a rule was added in 2008 under Section 121. This is any period of non-qualified use, which includes the years the property was a rental property before it became your primary residence. So that reduces the amount of gain that you can exclude. So here's the formula for that. We take the qualified gain, and that qualified gain ultimately is your total gain multiplied by the qualified use years divided by total ownership years. So there's a bit of a calculation there. But that is depreciation recapture is actually handled separately from that. So there's a calculation of how we figure out what that tax is. Number three is the 2 out of 5 rule does still apply. So the use of the Section 121 exclusion, you must still meet the standard test. You have to have owned the property for at least 2 years, and you have to have used it as your primary residence for at least 2 years within the 5 years before the sale. So if you moved in, you lived there long enough, you can use that exclusion, that 250 or 500,000 exclusion I explained. But again, recapture is still taxable. So let me walk you through a full example just to kind of put these pieces together. If you bought a rental property for $500,000, your building basis is $400,000 because we have to take land, set that aside. The building basis or your cost is then $400,000. You do cost segregation. You take $80,000 of accelerated depreciation, a $30,000 standard deduction. So combining these together, you take $110,000 of total depreciation. Then later, you convert this to your primary residence or your home. So your adjusted basis for that property is now $400,000 minus the $110,000 of depreciation. That now equals $290,000. 290 is your basis, or essentially your cost for the home. Years later, if you sell the property for $600,000, the total gain before exclusions will be $600,000 minus the $290,000 basis, your cost, which equals $310,000. So here's how the IRS then taxes that. We have a $110,000 depreciation recapture on that $110,000 that you claimed depreciation on. This is taxed at ordinary income rates, and it cannot be excluded under this 121, that exclusion for the homeowner deduction. The remaining $200,000 gain is then subject to a Section 121 gain exclusion. It is prorated for rental or non-qualified years. So even if you qualify for that $250,000 or that $500,000 exclusion, you still need to pay tax, the recapture tax on that $110,000 of depreciation. So key takeaways: depreciation stops the day you move in. All of the previous depreciation, especially the cost seg, it all still applies, but the basis is permanently reduced. The 121 exclusion is then prorated based on the rental years, and depreciation recapture is going to hit on the depreciation amount, and it is a taxable number. Bonus depreciation and cost seg can still be beneficial. It may create recapture later. This is where tax planning comes to play, because we can utilize other investments, other deductions, buying other properties to be able to offset those gains. So understand, in this situation, this is where tax strategy always comes into play in your investment decisions. In closing, if you're considering converting a rental into your primary home, or planning to sell a converted property that is in an area where the IRS rules get really complicated, they get complex with how all of this is taxed. At Engineered Tax Services, we help investors understand some of this. We do talk through the depreciation history, the recapture exposure, the basis adjustments, and the overall exit strategy from a tax perspective. But ultimately, we encourage you to discuss this with your CPA and to understand the implications prior to selling an asset. And then we can certainly help you on the strategy of how to offset some of that tax. We always offer a complimentary benefit analysis for cost segregation and lots of education, like in our video libraries here, covering everything from material participation to bonus depreciation. So if you want to learn more, click below or contact us anytime.